Welcome everyone, I'm your host Tom Bruni and you're watching What the FICC, the once weekly show where we discuss the most important chart or theme from the fixed income, commodity, or currency space. This week, our focus is on the US dollar index. Here we're looking at a daily chart of the traditional US dollar index over the last 2 years or so. Prices of the US dollar index have been extremely frustrating for buyers and sellers over the last 2 years, trying to break out and failing, trying to break down and failing, and just creating a messy trading range that frustrates everyone involved. But we think that could be changing right now. Over the last 2 weeks, prices have broken decisively below support near $96. We've seen that level hold roughly 5 times over the last year, and this time it was no match for sellers. We've got momentum getting firmly into a bearish regime by RSI getting below 30, and the 200-day moving average is now firmly downward sloping, signaling that the long-term trend has shifted to the downside. In our view, as long as prices are below 96, we want to be selling dollars, not buying them, and looking for a move back into the high 80s over the next few quarters. Now, the dollar is incredibly important from an intermarket perspective. It is one of the most important asset classes in the world. And so, whether you're trading US dollars or not, you want to be paying attention to this. First thing we want to look at is what's happening in the precious metals market. It's no secret that gold and silver have been rallying over the last year or so, but with the dollar index breaking lower and these assets priced in US dollars, that's clearly a tailwind for them to continue higher. As a matter of fact, last week gold traded at its highest weekly closing price in history. All time is a long time, folks, so we want to be paying attention to that. And silver, it added an additional 10 or 15% to its rally after breaking out above 19 about a week or two ago. Then looking internationally, we want to be paying attention to the dollar index and its impact on emerging market stocks. If base metals and precious metals are ripping to the upside, if the dollar is losing its purchasing power and inflation expectations are picking up, guess what's going to perform well? Emerging market stocks, things that are correlated with economic growth and activity, inflation. So here we're looking at the emerging markets versus S&P 500 ratio. It's been in a sharp downtrend for the last decade, but we're back down towards its all-time lows with momentum diverging. Could this be a potential turning point? Well, if it is going to be, this would be a very logical level for that to happen at, and a weaker US dollar would go a long way in helping that thesis. As you can see, the US dollar index breaking down has major implications across a variety of asset classes, and is one of the primary reasons we've been writing about it so much. If you want to learn more about what's driving this breakdown in the dollar, what it means from an intermarket perspective, and how we're taking advantage of it, head on over to allstarcharts.com/blog and you can read all about it there. That's all we got for you today, but if you enjoyed this, make sure to leave a comment down below, give us some feedback. While you're down there, drop us a like, and also remember to subscribe so that you receive more videos like this one from myself and the rest of the All Star Charts team. Thanks again for watching, and I'll see you guys next week.